Now that we've gone through a simple accretion dilution example, we can expand the exercise to start talking about some of the more granular adjustments that are going to need to be made in a more real or true to life accretion dilution model. So we touched on this a little bit, or at least alluded to it, but in the simple example that we just went through, we lumped the acquire and the target net incomes together. And in reality, before we can just lump the two net incomes together, there are several things that are sometimes significant that we have to do, that we have to adjust to net income. That's going to help in determining accretion dilution. In other words, even in a stock deal, there are some adjustments that we have to consider before we can just lump the two net incomes together. Those adjustments have to do with acquisition financing, synergies, fees, and accounting related adjustments. So now let's flesh out these other adjustments in a little bit more detail. So in terms of acquisition financing, in our simple example where we assumed a 100% stock deal, there was no real adjustment to the numerator. Recall, we just lumped the two net incomes together, and the big adjustment was on the denominator side where we looked at the acquirer's pre-deal share count and then added the number of shares that would be required to buy out all the stock of the target. Well, in the case of a 100% cash deal or a mixed deal, there's going to be some sort of financing required. So either the acquirer is going to use cash reserves that it has to make the acquisition, or the acquirer is going to have to take on new debt to finance the acquisition. So you can either sort of give the target cash by giving your own cash or borrowing money and giving that cash that you just raised to the target. So what that means is that on the numerator side now, there will be an adjustment because the new borrowing impacts the income statement in the form of incremental interest expense. And if you're using existing cash reserves, so when you think of a company like Google or Facebook, these cash-rich, or Apple, cash-rich companies, when they're going to do their deal, if they spend cash, rather than borrowing new money and having this incremental interest expense component on the income statement, you're going to have to reflect the fact that you're no longer generating interest income from the excess cash reserves that have gone to finance the acquisition. So that's whether you use excess cash or whether you actually borrow money, the impact on the combined net incomes on the numerator is going to be a reduction. The major adjustment to EPS in a cash deal is almost always the incremental interest expense that arises from additional debt that's issued to finance the deal. The next adjustment is cost savings, synergies. We talked about both the revenue and the cost savings potentially that can arise from synergies. The impact of that is almost always just positive to the combined net income. So you combine the acquire and the target net income plus the benefits of the synergies. Now we're going to talk about the nuances of sort of calculating those synergies. So they're usually expressed in the form of in pre-tax form, so we have to tax affect them. And of course, revenue synergies also have an associated margin that needs to be applied to it in the modeling context. But generally speaking, both cost savings and revenue, incremental revenues that arise from an acquisition, that's what's called a synergy. And that often represents the main rationale of an acquisition. And that's to make sort of significant cuts in expenses by eliminating overlapping R&D efforts, closing down plants, employee redundancies. Those are the kinds of things that we're going to model out in the form of synergies onto the income statement. As you'd imagine, the impact there is on the numerator as well, but it's a positive impact as opposed to the financing, which is a negative impact. Next, let's turn to fees. So investment banking advisory fees, the lawyer's legal fees, and the accountant's accounting fees, those need to be expensed as they are incurred on the income statement. So the accounting for those is fairly straightforward and I would say intuitive. When you incur an expense, when you incur the fee, that is recognized immediately on the income statement. It's expensed as incurred, and thereby that's a reduction to pro forma net income and therefore also a reduction to pro forma EPS. Now, underwriting fees are treated from an accounting standpoint under US GAAP and IFRS as distinct from the other transaction fees. So when a company borrows debt to finance an acquisition, the fees related to this borrowing, and whenever you take on debt, there are actually some immediate fees associated with that financing. Think about points when you're taking on a mortgage on your house. There are upfront fees for actually borrowing money. So the fees related to this borrowing are treated differently from advisory, legal, and accounting fees. Underwriting fees are capitalized rather than being expensed as incurred like the investment banking and advisory fees. The underwriting fees are capitalized and then amortized over the life of the debt issuance. This creates an incremental amortization expense, which reduces pro forma net income over the term of the borrowing. Now, the big difference is, whereas these fees, if you've got say a $5 million fee from a deal, that immediately reduces net income by $5 million, and presumably the cash goes down as the offsetting credit. But if you have a $5 million financing fee, the way that you treat it is you have to assess, so let's put an arrow here, and you sort of have to ask yourself, what is the term of the loan? Let's say the loan is 5 years. So the accounting for that is actually that you amortize it, so you capitalize it as an intangible asset. So immediately on day one, what ends up happening is, cash goes down as you pay the fee. So cash goes down by 5 million. Let's sort of do this way. Cash goes down by 5 million, and the corresponding entry is not retained earnings, but it's this intangible asset, financing fee asset, that goes up by 5 million, perhaps somewhat counterintuitively. And then over the next 5 years, the asset is amortized, right? So it goes down from 5 to 4 to 3 and on, while the corresponding impact there is a reduction to retained earnings via amortization expense on the income statement. And sort of the conceptual logic for this is, under US GAAP, the argument is you want to match the benefits of the borrowing, you want to rather match the benefits of the fees with the over the term of the borrowing. In other words, when you're borrowing money, that's going to give you some benefits. It enables you to do this acquisition, and it gives you the benefits over the term of the borrowing is the argument for amortizing over that period as opposed to expensing. FASB has actually considered modifying the accounting treatment here so that it is expense as incurred as well, to sort of bring these fees all in line. But as it stands now, this is the accounting treatment. Underwriting fees are capitalized and amortized, so make sure that you understand the distinction. So the very last sort of broad umbrella of adjustments are accounting adjustments, and these are the trickiest. I would say, as we start building our model, you'll find that these are the ones that tend to be the most complicated to wrap your head around. They're non-cash related. Beyond sort of the accounting, there's nothing really economically happening here as a result of the acquisition. So let's talk about these broad adjustments. So the big thing in an acquisition is all the incremental depreciation, amortization, potential one-time asset write-ups or write-downs that occur as a result of the deal. So bear in mind, we're going to get into this in a lot more detail shortly. The target assets, like property, plant, equipment, and intangible assets that the target has on its balance sheet, are written up to fair market value on deal day. Now, what that means is these amortizable and depreciable assets end up creating more depreciation and amortization over time. If an asset has a higher value because you've marked it to fair market value, now you're depreciating over the same useful life, all else equal, you're going to have higher depreciation going forward. And what that means is that incremental depreciation and amortization that wasn't there before, just simply because you wrote it up to fair market value. And remember, you can't write up most assets to fair market value unless there's something like a change of control that would merit the write-up. And so all of a sudden you have this higher depreciation and amortization, which reduces pro forma net income over what it would have been without a deal. Because of course depreciation and amortization reduces net income. It's depreciation and amortization is baked into the cost of goods sold, SG&A, other operating expense line items, which reduces pro forma net income, and as a result, pro forma EPS. So these accounting adjustments, which are not really economic adjustments, end up being dilutive by themselves, which is why we actually see a lot of times, and as we'll go through in our exercise, that a lot of analysts exclude the impact of this when analyzing the accretion or dilution. Accounting adjustment, there's one other accounting adjustment, and that is a major accounting adjustment in most acquisitions, and that's the creation of goodwill. So goodwill created in an acquisition obviously can be pretty significant, and it's certainly in our case today, there's going to be a significant amount of goodwill created in an acquisition. We'll talk a lot about why that happens and the accounting that underlies it. But the main thing that we have to keep in mind from a accretion dilution standpoint is that goodwill does not really have any impact on the income statement. Certainly, at least not immediately. Goodwill was amortized a long time ago, over 10 years ago, the accounting was that goodwill would be amortized just like other intangible assets. But that hasn't been the case in over a decade. So the accounting for goodwill is just stays on the books, and the only way that goodwill flows through the income statement in any way is via an impairment. And certainly we don't forecast any impairments when we build an accretion dilution model. The sort of implicit assumption when you do an accretion dilution model is that this acquisition will not be a total disaster, which is what a goodwill impairment implies. So lastly, before we get into our sort of mini exercise, a slightly more complicated version of the accretion dilution exercise that we just went through, but not quite yet a full-blown accretion dilution exercise. The last thing that I want to mention before we get into that is how accretion dilution is actually presented in practice. And usually it's presented using a data table in Excel. You see something like this, where you have the peanut butter acquires jelly, and in year one, accretion dilution looks like this. So at various sort of forms of consideration, if we sort of sensitize our model to show stock versus cash, and then the range of offer prices, what is the accretion dilution that you'd expect to see, and what does that represent as a premium to the market? So obviously if it's a sort of mostly cash deal, the deal becomes quite accretive. Obviously, the lower the offer price, the more accretive it is to the acquirer. That would make sense. If you can get away with buying the same company for less, that's going to make your financials look better because you have to issue less stock, you have to borrow less money. And this represents the premium that you'd have to pay over the market price of the target to make the deal happen. Okay, now that we've talked about all the adjustments that typically make up an accretion dilution, broadly speaking at least, in our next video, we turn to doing a simple exercise where we look at what would happen if Google was to acquire LinkedIn from an accretion dilution standpoint.